All right, let's talk about Coinbase's latest earnings report. Now, the headlines, they told one story, but if you actually dig into the numbers, well, that's where things get really interesting. So this was the number that was plastered everywhere, right? A net loss of $667 million. I mean, you see a number like that, and your first thought is, yikes. It just looks like an absolute disaster on the surface. And of course, a loss that huge makes you ask the big question. Is Coinbase's whole empire starting to crumble? So let's really get into it because the real story here is so much more complex and frankly, way more interesting than just that one scary number. Okay, so to get to the truth, we first have to find our way through what we're calling the earnings fog. You know, the official report. It paints this gloomy picture of a company in serious trouble. But to see what's really going on, we've got to look right through that haze created by standard accounting. And the first big clue for clearing this fog, it all comes down to a new accounting rule. Basically, it forces companies like Coinbase to report the ups and downs in the value of their crypto as profit or loss, even if they haven't sold anything. We're talking about paper gains or losses here. And the crazy part is, they now hit the bottom line, the official profit number, directly. And here's the absolute kicker. That entire loss we saw, it was driven by over $1 billion in these non-cash paper charges. So this isn't a story about the actual business operations losing money. No, this is a story about accounting. So where did this paper loss come from? Well, it's basically two big chunks. First, a $718 million hit just because the value of their crypto holdings went down on paper. And second, a nearly $400 million write-down on some of their big investments, like their stake in Circle. The most important part, not a single dollar of actual cash left the company for either of these things. Okay, so now that we know what's causing all this fog, let's do it. Let's peel back those paper losses and take a look at what the real core business is up to. And I'm telling you, this is where the entire story just flips on its head. And wow, this slide just lays out the disconnect perfectly. On one side, you've got the official by-the-book net loss, negative $667 million. But then, look at the other side. Adjusted EBITDA, that's a number that strips out all these paper losses. It's a positive $566 million. That is a swing of over $1 billion. It's just two completely different worlds. And this isn't some one-time fluke either. The crazy thing is, Coinbase's underlying business has been churning out positive adjusted EBD for 12 straight quarters. That's 3 years. So that scary headline loss, it's basically an illusion, a trick of the light created by a new accounting rule, not a problem with how the business is actually performing. But look, for the ultimate reality check, you know what they say, cash is king. You can debate what profit means all day long, but cash in the bank? That's real. So let's follow the money and look at the cash flow statement. Okay, this right here, this is where the story becomes just undeniable. In the exact same quarter that the income statement showed that $667 million loss, the company actually generated a staggering $3.1 billion in free cash flow. I mean, that's not just a small difference. It's a totally opposite reality. And this kind of cash generation, it's not new for them. It's how they've built this absolute fortress of a balance sheet. We're talking over $11.3 billion in cash just sitting there. That's your ultimate shield against whatever the market throws at you. And they're not just letting that cash sit around. Management was smart. They used $1.7 billion of it to buy back their own stock. And what that did was completely cancel out all the new shares they gave to employees, which is a huge deal because it protects all the other shareholders from having their ownership stake watered down. So you gotta be asking, where is all this cash coming from? Well, it all goes back to a fundamental shift in Coinbase's strategy, one that I think a lot of people have missed. They're not just a simple exchange anymore. You see, Coinbase has moved way beyond being just a crypto casino that lives and dies by trading fees. Just look at this breakdown. Almost 40% of their revenue now comes from much more stable, predictable stuff like subscriptions and services. And that part of the business grew by an impressive 23% last year. And this whole strategic shift is really built on 3 powerful pillars that create a massive competitive advantage, or a moat, for them. First, they're the most trusted and regulated place to be, and that attracts the big money. Second, they're building the actual roads and bridges of the new internet with their own infrastructure, Base. And third, they're at the very heart of the USDC stablecoin, which is becoming a core piece of this new financial plumbing.
All right, now this analysis would be totally incomplete if we didn't take a hard, honest look at what could go wrong. No company is perfect, and for Coinbase, there are definitely some big risks brewing just under the surface.
Two things really stand out. First is what's called goodwill risk. Coinbase paid a huge premium, $2.9 billion, for the Deribit exchange. That extra amount is called goodwill, and if that purchase doesn't pan out, they could be forced to write it off as a massive loss. The second is governance. They moved their corporate registration from Delaware to Texas, and some people are worried this Dexit could weaken the rights of smaller shareholders, which always raises red flags.
So this creates a really interesting situation, kind of a paradox. On one hand, their balance sheet is stronger than ever with hard assets like all that cash, but on the other hand, it's also getting riskier with more soft assets like goodwill. It's a tricky balance that investors really need to keep a close eye on.
So let's wrap this all up. The story really has two totally different sides. You have the illusion presented by the official accounting numbers, which looks like weakness, but then you have the underlying reality, which shows a business that's profitable, is an absolute cash-generating machine, and is making all the right moves to evolve its business model.
And that leaves us with one last big, provocative question. If the market is just reacting to the accounting noise, to that illusion, instead of the economic reality, does that mean it's fundamentally mispricing one of the most important companies in the future of finance? Figuring out the difference between that noise and the reality, well, that's the billion-dollar question, isn't it?